cooking this week. Hey guys, we're live. This is a commodity report. We've got Kevin and Sam with us today. A bunch of interesting stuff to talk about. The markets have been pretty flat for commodities. Energy-based commodities have been under a lot of pressure. Softs have looked decent. Ags have been under pressure. Kevin, so you wrote a recent article. I'll link to it so people can check it out. But what were you talking about there? Can you give a little bit of background on it? I know you always have great information and timely information for things like this.
Yeah. So, obviously there's a lot that was actually happening over the weekend when it came to the Syrian conflict, right? And I won't get into the politics of it, but I think it's really important for us to actually have an understanding and a background of what actually happened. This is probably the quickest reversal of a regime or front of a regime that we've seen in a very long time. And a lot of people are comparing this to Afghanistan and how the Taliban were able to take over, which took like a month to fully kind of take over when it comes to the Taliban in Afghanistan, whereas these rebel forces, were able to kind of topple the regime in a matter of 10 days, 14 days, kind of depending on how you look at it. What's different with this one, though, is that it's around 6 different factions that are a part of this, right? So we still don't know and have a clear understanding of how the governmental structure is going to work post this, Assad leaving and fleeing to Russia. But it is actually very significant in several different ways. And I only highlighted 2 within the article and kind of kept it high level. But there's 2 really key ports within Syria that basically allowed Russia to transit between the Mediterranean Sea and the Black Sea, right? And the Black Sea has Crimea. Crimea, I don't even want to get into the politics of that, but you could say that it's Russian occupied or it's Russian territory, depending on what side you kind of land. All I know is that Russian forces are there, and they've been able to utilize Crimea as a really key hub to be able to transport goods, right, back and forth. And a lot of the goods that I'm kind of focusing on here in this disruption is going to be grains, and in particular wheat. So what the Russians would do is they would take their wheat exports and then, transfer it over to Syria or even into Africa, right, where Russia is continues to build a significant amount of influence within Africa. But now, since these rebel forces have taken over, Russia seems like they're moving both of their naval fleets out of both of these really key ports. And then that's going to leave a little bit of a void when it comes to wheat imports for Syria. Now, what's going to also happen, we have to keep in mind, anytime a force takes over and overthrows another force, what's the number one thing that they really need is you need to be able to build morale with the citizenry, right? And it seems like if you're looking at it, 1,000 feet up, it seems like they're trying to do that. But the quickest way for you to piss people off is to mess with their food and mess with their money. They don't have a lot of money there, and it's really tough. But and the food sourcing is once again kind of concentrated to only a couple of partners. So the question now is going to be, how does these rebel forces, whoever takes power, however they shake out, what new deals will they make? Will Russia come back into the fold, which I think is a little bit difficult, right? Like, how are you going to build another relationship with Russia and continue to have these import-export deals when the guy that you just kind of overthrew and hate, Russia just gave asylum to, right? That's a little bit tough. That could also give Ukraine, though, the opportunity to be able to build their own deal when it comes to grain. And so that could be a lever for Ukraine with any type of deal that could be made. But it will also, once again, kind of disrupt the flow of wheat overseas. Now, the reason why I say it's kind of like a weird trade, because it's not like, boom, this is super bullish for wheat, go all in. That's really not the case, because we don't really know what the government structure is going to be. But there is an opportunity there for some vol in wheat. And the vol, I think, would be upside vol, meaning upside potential, right? Increased volatility, upside potential, rather than downside risk, which we've already seen a lot of that push to the downside there. So that's one area. I also kind of wrote, and this is kind of an ongoing piece. This is kind of the third one that I've written in the last, let's say, month and a half, is on the uranium trade. The uranium trade is very interesting too, right? We know that Russia is going to reduce and probably eliminate uranium sourcing for the United States, which is very key, because they command 20 to 25% of enriched uranium when it comes to exports. And it's something that you just can't go out and say, oh, hey, here's another country, let me just source from you. You also have to enrich the uranium and have that infrastructure in place. France has that. And the reason why I bring up uranium is because Russia has been supporting a lot of these, coups in Africa. If you're looking at Niger or some of these other countries, and a lot of these other countries that are kind of getting new regimes, they're kicking France out militarily. And they're saying, hey, you got to get out of here. We don't want you here anymore, which is once again going to have an impact when it comes to uranium sourcing as a whole, which is why you saw the CCJs of the world kind of pop to the upside, right? That's the reason why we have that trade. But with this dynamic that we have in Syria now, and once again, it being a lever, now there's kind of a little bit of you have some leverage. In Turkey, I didn't bring this up, but Turkey has been a huge supporter of some of these backed rebels. Some of them are not good people. Let's just call a spade here. Some of these are former Al-Qaeda members and offshoots of potentially ISIL or ISIS, right? And so I kind of made a tweet the other day, like, hey, be careful for who you root for. I don't think we root for anybody in this case. You sit back because both sides are not the greatest at all when you're looking at the totality of both of these But if you're looking at it from an ops standpoint, that's never stopped us before in the past, supporting people that we don't want because we choose the lesser of two evils, or we perceive that to be the case. And so, once again, we have a little bit more of our leverage here, and this could be actually a pawn in a chess game for the uranium trade here, which means that the uranium trade, I think, over the long term will still be bullish, but in the near term could actually face a little bit of pressures if that is going to be on the table. So that's kind of what I wanted to highlight here. It's not going to have an impact when it comes to equity markets for now, right? If the spill's over, then probably, but this is just showing that Russia is so tied up with the Ukraine conflict right now that they couldn't even provide basic support to at least slow down this advance or resistance. They probably low-key signed off on this whole thing, right? Just kind of get it over with and try to save face. But then it also puts into question those African nations that are trying to build support with Russia to say, hey, well, you bounced on them, you dipped on them, are you going to dip on us? Once again, an opportunity could be had there. So disruption in wheat logistics, especially when you're looking at Syria and some of those Middle Eastern and Western countries, that could actually boost export demand when it comes to the European nations. And then we could backfill, right? Meaning that we wouldn't sell directly to like a Syria, right? But we would sell to a European nation, and then they make a deal, and that's how trade works, right? We could both produce the same thing, but I could ship you something, you ship something else out, and all hands are clean. That's similar to what was going to happen with Venezuela and the United States, right? Breaking down those deals. But the intermediary there was Mexico. Mexico was going to be the turnaround hub to make our hands look a lot cleaner, that we're not doing a direct deal with Venezuela. So that's how this is all panning out. People are noticing the oil trade. Honestly, oil is not going to be impacted by this. So I would say oil is kind of doing its own thing from a technical standpoint. We've been talking about the $67 level, the $66.50 level, buy and then scalp, sell at 68, sell at 70, rinse, repeat until you get something that's there. But the oil trade for Syria is already kind of wrapped into, I gotta pop this thing off. It's already being wrapped into, I'm sorry. So the trade, I had to pop a trade off there real quick because I was trying to get that equity balance. So my apologies there. And I caught the balance. I was like, oh, let me pull this out. Jesus Christ, I was just trying to figure out. Oh yeah, the Syrian oil infrastructure is really tied into to Iran, right? And so there's not really anything that's there. The Kurdish forces, which has some exposure and territory when it comes to northeastern Syria, have taken over a lot of the oil infrastructure that's in place, but they're not like a major player that's going to disrupt the global supply lines, if you will, right? It's going to disrupt maybe some dark fleets, but not something that's going to be like holistically on the table, like, oh my gosh, this is going to be a bad thing. But I think the oil trade, once again, is kind of, people think Middle East, they go right into oil, but like there's nothing that's like fundamentally going to truly disrupt supply or logistics. If anything, it's going to screw over Iran more than anything.
No, I like that viewpoint because generally you're right. People, they hear Middle East and they go, okay, I better buy oil. And you see these spikes in oil, and most of the time they're misguided little spikes that happen on anything. And not to mention, if you look at the people continue to go back to whatever the last crisis was, Russia-Ukraine crisis last time led to a high rise in oil prices. However, there was a lot of reasons for those oil prices to move higher at that point. So, Sam, I want to go back to CCJ. So, what were you seeing on that CCJ chart? Because you had some great fib levels marked out there. You had a really long-term base. What are you looking at here on the CCJ chart?
Totally, yeah. Looks amazing. I think Kevin was saying like the geopolitical risk at the moment is that these companies can't get the enriched uranium, and like that's what CCJ is doing. They are involved in that. Like, so I feel like that's the place to be if you're looking to buy uranium stocks. You want to buy the ones that are enriching it, like the CCJ, breaking out of a multi-decade base. And I think you have a very similar chart here with uranium energy, which is just a little bit more junky than CCJ, but very similar trade. You can own as much as you want above these prior highs, in my opinion. Looks fantastic.
And so, go back to the wheat chart as well. Let's break out some levels on that thing because it also looks like it's been chopping around quite a bit. So we could break down some levels and just see where we would buy for a major trend change. And then I want to ask Kevin if he's just looking for some pops here, or is he looking for a major move?
Yeah, and Kevin, I wanted to ask you about the wheat ETF, like because it looks almost more attractive than the futures. Like you can buy it against this shelf of former lows here. Like that's easier to define your risk. Nonetheless, wheat looks pretty interesting here. The way I see it is you have one big base here, and then now we're carving out a second base. So a recapture of this VWAP would signal to me that the bulls are taking over wheat, and they're likely to take it back towards 700, in my opinion, and it could happen fast.
So what are you looking at, Kevin? You looking for a short-term
Yeah,
move?
I would say for the short term, you fade uranium right now because like the thing that I was kind of talking about is actually favorable for supply lines if it is going to be a lever with the negotiations. So, and it would be a short-term setup. I'm not saying something that's like, once again, I think there's a longer-term vision for uranium.
Isn't there kind of a structural shortage of this enriched uranium? Do you think lasts longer than this year?
Yeah, well, so right. So yeah, let me just clarify here. So usually like when I talk about trade setups or things, I'm talking about it like usually on a week basis, unless I'll state otherwise, right? So I would say like the news that we had over the weekend would be a fade for uranium for like right now. Like the trade is literally taking place as we speak. Is down what 2%, right now 2.5%. Is there a structural shortage? Not right now, as far as physical supply. In 2025, there will be. Because when you buy these companies, they don't like, next week, or next month, I need to, buy more to make sure we have, enough uranium on supply in order to fuel our nuclear reactors, right? These companies go out a year and a half for their orders. So right now, what we've seen, the actions that we've seen over the last, let's say 2 months, 3 months, is probably going to impact us by June of 2025. That's where your longer term vision is, right? That's where it becomes very structurally hard. So the physical supply itself is already accounted for right now. Let me clarify this. The physical supply for now is already accounted for. That's just like when you buy corn, or a producer is trying to sell corn mill, right? They're going out and they're looking farther in advance and locking those physical deals in. They're not like harvesting and like, okay, like we have our corn now. Like, what are we going to do with it? They're looking farther and farther out. The structural issue is when we get to mid-year, July 2025 is where you're going to have a really big problem, which is where the uranium trade like comes into play. So short-term fade, and I would say short-term fade like the next couple of, like for URA, you could see a technical support area sitting at around 29.70, right? So short-term fade, but the longer-term vision is definitely still there and intact. And so that's kind of the differences that I would say when it comes to a commodity like uranium, which once again is, we're trying to see what's going to be projected out into the future as far as supply, and the supply in the future is going to get tough, but the supply that we have right now is already accounted for and the logistics are pretty much in place. The fact that we would see somebody default on a delivery, like say from Russia, would be detrimental to their own economy as well. And that's usually how not how these things work. Like we usually, like, let's say we wanted to ban corn exports to China. We just don't put a ban on right now, right? Like everything, we'll say, hey, the ban starts today, but contracts are still deliverable up to a certain point. You can't do anything past XYZ point, right? So we'll say, hey, it's banned, but there's going to be things that are already accounted for. Uranium's kind of the same way. I would be very surprised if Russia just said, okay, immediately stop today, because that would have, once again, a very big impact when it comes to their own domestic countries, which they're not going to want to see right now. You're talking about a country that has seen the ruble literally collapse. You're seeing sentiment in some respects maybe weakening here, and we could see Belarus as a proxy for that. Belarus will also have an election, a presidential election in January 2025, so keep that one on the radar. But yeah, that's so if that kind of makes sense. And then the risk reward when it comes to wheat seems like there's more upside potential than downside risk. The weather for wheat, though, and I'll kick it back, the weather for wheat is actually very favorable for the growing season. So that's been the bearish take over the last 2 weeks for wheat, but I think it's basing out enough. I think the market's really trying to find its floor there.
No, good stuff. And I think generally when we look at these trades, something that's really, especially like you said about wheat, that's been the story the whole time, and it's been shifting over time, which the wheat market prices really stiffed that out. Like they continued to say that was not a great forecast, and it really has changed recently. But I do think that there's a good move here, short term, like you're saying, Kevin. You could see a nice short-term pop in wheat. There's a lot of reasons that's a favorable trade. And so getting into some other things, let's get into gold. What's going on with gold right now? Do we think that this is just another pullback to buy? Do we think that it's finally getting above those levels that it's safe to buy, or would we wait, sit on our hands? Sam, go ahead and start. What are you thinking about this gold chart here?
This is it for me right here. I've been watching this anchored VWAP from the all-time high. It's come in as resistance on numerous occasions, and it looks like the bulls are trying to take control today. Of course, you want to see them close above here. You want to see them follow through tomorrow, but it's looking good for them, and I think it's hard for me to talk about gold without talking about silver. You have silver finally bouncing off of this level. It's kind of wearing the bulls down. It's just refusing to really get started here, but it seems to be happening now. Then you have one of the best seasonality periods of the entire year for precious metals. I think there's just a lot working in its favor, for sure.
Yeah, and I also saw China's coming in and starting to buy again. And I'll pass that over to Kevin. Kevin, what are you seeing in the on the fundamental side? What are we seeing in gold and precious metals right now?
Yeah, I think you're exactly right. Right, like so China is gonna once again buy gold. They've held off for around 6 months. I think the last time they purchased was in June, if I'm not mistaken. So they're gonna go back to purchasing gold for right now for the reserves. They also announced, some other measures overnight when it came to stimulus measures too, which is why you're seeing broad-based participation when it comes to the reflation trade as a whole. I could call them off top, and I haven't even looked at all of these products yet, but I know silver's popping to the upside. It's up 3%. Gold's catching a bid because of that China news. Copper, I would suspect, is actually green here on the session, probably getting a little bit of a bid. Let me see what copper's doing right now. Yeah, copper's up 2%. Copper hit about $4.29.5 here today. Palladium's catching a bid. You're seeing soybeans were catching a bid earlier. It looks like they fell off there. Soybeans actually was rocking it earlier this morning. But so that's the China trade. I think if you're looking at it from a technical standpoint for silver once again is that industrial production trade as well as the inflationary trade, China reopen story. So it is trying to base out here. If I'm looking at the silver futures contract, it could try to attempt the $34.66 level before seeing an area of resistance, but it does seem like it's trying to base out and curl higher for now. And then for gold, once again, you could kind of ride that trend as you see fit. And then we also have the Fed meeting next week too, right? And so you're seeing yields, I think, actually move to the upside here today. It was moving actually pretty aggressively. Yeah, yields up today. So you can make the gold trade on the FOMC meeting. But reflation is the trade right now. Once again, crude is not moving up because of what's happening in Syria. It's the optimism in China.
Yeah, I think that's a good point. And silver, to me, we had a very buyable dip that kind of came in there. It was the same thing with gold. But once again, it's people when you look at silver and you've been getting hit by silver for so many years, again and again, so many people just kind of go, well, you know what, I don't really want to buy this. There's probably better trades, and especially any opportunities to buy, you don't really want to. So I see that happening a lot. But I do see Sam and I were putting out stuff talking about buying that dip as long as it held these levels. It's holding these levels. It's bouncing to the upside. I think it still has some more upside to go. I'd love to see it hit those, break out of that high, which would be a longer term trend that Sam and I have been talking about for a long time as well. So, looking at that, what space do you think is going to move more? This is totally a speculative thought, but do we think it's going to be gold, silver, the miners? What do we think is going to move the most in this next part of the precious metal cycle if gold starts to hit new highs again?
For me, I think you want to eventually rotate down the cap scale to like a platinum. Platinum, zero reason to buy it today, to be frank. But I see the setup, and I think that could have an extremely explosive rally soon. Could be another couple of years, but I plan on making that one of my biggest trades of the year, maybe in 2025, 2026. I see it. And like in the prior cycle, you go back and platinum had a very similar setup, and it just pretty much went up in a straight line during the last precious metal bull market, while you had a little bit of a bumpier ride in the other futures. So
Interesting.
I'm kind of excited about that one.
Nice. What do you think,
I
Kevin?
think silver. Any day of the week. Silver is a higher beta play on the metal scale than gold. I think the China story next year will come to fruition. I'm a very firm believer of that. And if you kind of look at the silver chart setup, I think it's right for maybe a little bit of a move to the upside. Platinum and palladium are just very tough because it's the optimism when it comes to automotive and hybrid that makes them work. They're utilized in catalytic converters and things like that. And if you kind of look at what's happening in V-dubs, pretty much almost every single automaker maker out there, they're all having problems with scalability and demand. And so it's a tough trade. I don't know if I know there's a palladium ETF, PALL, that you can use as a proxy. I'm not sure if there's a platinum one. I would caution anybody.
Yeah.
Okay, yeah. I would caution anybody from actually trading the future. If you want to talk about nerve-wracking, natural gas, yes, it is nerve-wracking, but liquid, and there's a trend there. this palladium and platinum, when you see the spreads themselves, sometimes the spreads could be over $300, just the spread alone.
Palladium,
just the spread
especially.
alone.
Yeah.
Yeah.
Platinum isn't
So,
nearly as bad, but palladium is really bad. It's
yeah.
really-
So I would caution anybody that's not very familiar on how to trade those to probably stay away and utilize the ETFs. Make yourself you feel better at night, sleeping at night, rather than
Kevin,
trading.
I've been looking at the COT for palladium for some time now, and I think we're all aware that commercials have never held this much palladium in history. Do you think that is something that needs to reverse in order for this price trend to reverse as well, or how do you see that? Because that's kind of how I see it. It's like once those commercials get net short again, flip the book long.
Yeah. Well, I think Andy had this question yesterday, and I didn't respond. You guys responded. I didn't respond. So I look at the commitment of traders report and say, like, whatever the commercials are doing. Let me say it like this: whatever managed money is doing, you want to kind of do the exact opposite of that, in my opinion. And then whatever the commercials are doing, it has to be able to tell a story. So when we talk about commercials, those that actually have business within the physical commodity themselves, right? They'll sell contracts in order to lock in prices, and they'll buy contracts in the event that either there's a supply shortage and they're not able to cover, or they'll buy back any type of net short that they have, right? So commercials can be short. And this is just an example, 100,000 contracts. And let's say that's typically what they've been doing, but the market's been crap for whatever reason, and they may need to cover because the physical is just not there, right? You don't want to be overhedged as any type of physical dealer. So I kind of look at it and say, until you start to see the shorts kind of coming in from the commercial side, that's usually, once you start seeing that, that's usually where you start seeing those power moves to the upside. And what I find very interesting, and you can go back and look at crude. Crude's the same way with this, Natty, pretty much almost all of them, right? As soon as people see dealers or commercials starting to sell contracts, they feel like that's bearish for whatever reason. And so, like, it seems like managed money is always a little bit behind here. So I'm not sure if the net short is so aggressive. Well, let me say that it's always been aggressive when it comes to platinum, palladium, and natural gas, right? But how much more aggressive can it get to the downside to continue to fuel the move, I think, is the biggest question. But any meaningful uptick or covering by commercials, I think, is the first sign that something can happen. I'm sorry, let me say the last thing here. There's not a lot of people that trade these contracts. So I also understand that you're going against heavy hitters whenever you're making a trade against that, or like with them. So it's not like there's hundreds of thousands of just retail speculators in this name, and platinum or palladium that's creating these markets and providing the liquidity. You're going up against probably 200 different actual institutional traders for the CME product as a whole. So you got to also kind of be like on the right side of that trade. And I think that's where you just follow what the commercials are doing.
It's pretty much just like CTAs and producers, right?
Yeah, well, so you have CT. So there's several different breakdowns. So you have commercial. We call them commercial or dealers. Commercials are for physicals. Dealers are for non-physical.
So he's talking about for palladium specifically.
Yeah, right. Well, this is going to be for any commodity.
That there's no retail traders here.
No, I mean, not like, I mean, you're going to get a couple of them. I mean, I know a couple of them that do trade it, but nobody that's got a substantial amount of size or anything like that. I haven't seen anybody trade more than 100 lot of palladium or platinum, which is actually a significant amount.
That's a lot. A one lot on palladium is, if you have $1 million account, a one lot is basically normal for a trend following system. I always tell people about palladium, and I would say, yeah, I always followed it. I always kept in mind that I was going to trade it one day, but it took years of building an account to be able to trade something like palladium. Because I'll watch people get interested in it and they'll be like, yeah, I'm going to buy a palladium contract. I'll be like, dude, if you don't have like a very substantial amount of money in your account, or if you're trading, you know, for a fund like me or something, like it's really hard to trade palladium futures.
Yeah, and each contract's like 26 grand, 27 grand for margin. Just
Yeah.
one contract.
Yeah. So you got to have substantial cash to do it. You've got to be able to, you know, really understand like the trends, the volatility of it. Because that's the thing, like Kevin said, you could if you're literally trading that contract, like the first time I ever traded that contract, I can remember being like, wow, it just jumped, you know, a whole percent in 5 seconds. You know, like it basically can, if you have tight stops, you're going to get whacked out and you're going to get bad fills over and over again. There's a bunch of things that can happen. So a little bit of risk there. I agree with Kevin. Use the ETFs if you're of small size. And luckily, there are ETFs for things like palladium and platinum if you do want to take that trade. I do like the idea of talking a little bit more about the COT stuff. Commercial traders, a lot of people have been talking about that lately. I did post a video the other day. I could post that in the chat too for you guys who didn't see it. Kevin and I made a video on this a while ago where Kevin goes through the way he looks at commercial markets, how they trade. It's a great video. Kevin really breaks down some great stuff there. I'll share it once again. But looking at that, I want to ask Sam, because you wrote about this the other day, which was the euro actually getting to a substantial long position for once in the commercials, and we haven't seen that in a long time. So what are you thinking here about the dollar, Sam? What are you thinking about the euro, the positioning? Just break it down a little bit.
For sure. Just going back in history, in 2022, the dollar ripped a lot, and then it ended up falling towards the end of the year, and that's kind of what marked the low from an equity standpoint. Dollar peaked and stocks bottomed, and a month before that happened, you saw the commercials get net long euros, which is a rare sighting, and it didn't immediately happen, but eventually the dollar rolled over. And so I think they're kind of sniffing that out. And you look at the technical landscape here, like I'll pull it up. We've been talking about the upper bound of this range for so long now, and we're finally starting to see sellers show up here. So that's where my head's at with it. What do you think about that, Kevin?
Yes. And also, Kevin, feel free to talk about interest rates, the Fed, anything. And we'll just end there because I know you got to leave in a bit. So interest rates, the dollar, like what are you thinking here? Because I want to know your opinion on that too, Kevin.
Yeah, so I feel like the dollar will break down. And I think, I mean, we can see what the range is doing right now. It's also going to be dependent on policy too. And we went over that in the last video. You guys can check it out. But I feel like the dollar is going to, I think, probably be range bound here for a little bit. Until we actually see a meaningful deterioration in the U.S. economy, I don't think that you're going to get weakness, a meaningful weakening when it comes to the dollar. As far as us being better economically than, let's say, the Eurozone. The other thing when it comes to positioning to be mindful of, when you're looking at leveraged money in the euro, it's the highest net short. I just had it. It's the highest net short we've seen in like a very long time. So there's also that that's also taking place too, right? There's a lot of people that are shorting this, which is why I also then believe that's why the dealer positioning is reflecting exactly that, right? The opposite side of that trend when it comes to lowest net short or net long position. But I don't think that we're going to get any meaningful drop in the dollar until we get weakening economic data here. And I just don't think the market's really pricing that in right now. I also don't think the dollar is going to rip higher. I mean, I find it very hard for the dollar to sustain above 107.5, 108 as well.
Kevin, isn't it kind of just like, I don't know, like you're saying if the U.S. economy shows cracks, then that would be a reason for the dollar to decline. But like, wouldn't Europe be doing worse in that scenario? Like most likely, like that's kind of the game we're playing here. Is like the U.S. is the best game in town. So
yeah,
I kind of
which I think is priced in, right? That's why it's priced in.
Yeah.
So the Eurozone is not doing great. Germany is the largest economy there, and Germany is not looking great at all. I think that's already been, once again, I think that's already being priced into the dollar. So I don't know if there's going to be anything that's going to like material. Either we have, you know, a recovery for the euro, the eurozone in the next, you know, 2 quarters, 3 quarters, and you start to see the euro actually catch a little bit of a bid, which weakens the dollar, which could, because when we talk about currencies, everything's relative to a pair. It's not just in its own thing. So you either need to have euro strength to knock the dollar down, or you need to have U.S. weakness to knock the dollar down. One of the two, and one of them has to be greater at some point in time for me. Now, when you're kind of looking at cycles and going into past cycles, the dollar should break down. It's not for right now, and I think that's something that before I was like, hey, yeah, the dollar is going to continue to break down, but I'm questioning that a little bit, because if we have this normalization when it comes to yields, which is probably what you're kind of getting at, Jason, right? If we have this normalization, when you kind of look at these cycles, the dollar usually goes down. That's because economic weakness is taking place. That's because the Fed took too long to cut rates. That's where we have these cycles. And we've seen those happen in the past. But what's different this time, maybe, is that yields are not going to go back to where they were. The Fed's really trying to find what that neutral rate is, and that neutral rate most likely is going to be in the 3s, somewhere in the 3s, low 3s, mid 3s, maybe even high 3s when you're looking at the Fed funds rate, right? And trying to balance out economic growth. If that's going to be the case, then we probably won't see as aggressive pullback in the dollar as we have seen in the past, because before our ZERP type of policy, we were sitting at around 3.5%, 4%, 4.5%. For treasuries, right? So we kind of went too far on one side. Now we're kind of like finding that equilibrium. And so I think you swing it for right now. Euro, lastly, I will say the euro reaching any type of parity for the US dollar is something that the ECB will have to take action on, and they do not want that to take place. So there's also there's an ECB put that's probably taking place at the euro with parity to the dollar. You don't want that to flip. So I think that's also another reason why I say I think it's just going to be kind of meandering where it's at right now. I don't feel like there's going to be any type of meaningful adjustment over the next 6 months, one way or another, when it comes to the Eurozone, when it comes to the dollar. And the only other thing that could actually derail that would be a yen trade, which the yen's, 15-20% of the dollar index? I think is 15%. So you would have to have a substantial move in the yen, which could happen. It's the most volatile major pair that's out there. Major currency that's out there. So that would be the only thing I would say would really rock the dollar to the upside or the downside here. I think this is probably where we go. And I think the low on the dollar over the next 6 months is going to be 95. So 108 resistance, 95 support.
No, I like it. So let's wrap it up there, guys. So we're on every weekend, 11 a.m. Eastern time. If you guys have questions, feel free to write in. We'll try to cover them here. All right, guys. Have a good week of trading.